How's it going, everyone? This video talks about why I invest when everyone else is fearful. What exactly do I mean by fearful? The Fear and Greed Index tells us the status of what is moving the stock market. What emotion? Are people selling at an unproportionate level? Or are people overbuying stocks to the point where everything becomes overvalued? So the scale that you see on your screen right now, it goes from 0 to 100, right? A metric of 50 means that things are normal. It's neutral, the way it should be. When the number dips below 40, then you know fear is in the streets. And as of right now, the stock market is operating at a 34, and the market is fearful. I try not to watch the news because I prefer my life to be peaceful, but it's hard to see the headlines of what is going on around the world. There's a lot of crazy things happening. And it looks like the market is pricing in the fact that the interest rates might stay higher for a little longer, which means dividend-paying stocks will suffer a little longer as well. Just like that poor little office chair that's been supporting your body as you've been gaining weight year after year. It's barely on its last leg. Let the poor chair go. Whenever I see irrational fear in the stock market, I remind myself of what Warren Buffett said, this handsome gentleman on your right. Be greedy when others are fearful, which basically means to do the opposite of what the masses are doing, to be a contrarian. When others are scared of the macroeconomic conditions, wars, inflation, and whatnot, prices will drop and your emotional brain will second guess all of your investment decisions. But money and wealth is generated when you can find the right opportunities in the midst of a storm. I'm telling you. Again, thinking like a contrarian to the masses can be the answer. For instance, when everyone else in your neighborhood decides to use AC in the summer because it's hot and humid, you can choose to use that heater so that you can work up some nice boob sweat after work. Actually, that doesn't sound very fun. Please don't do that. So what does being a contrarian look like in practice? For me, when the market goes on a sell-off and stocks go on a discount, that's exactly when I start shopping around, especially if I know a high-quality dividend compounder stock is being depressed due to fear in the market. For instance, Starbucks, McDonald's, Hershey, Humana, American Waterworks. If I know the company is doing great, running their operations the same way it was 2 months ago, and nothing drastic has changed about the company, why wouldn't I like it when it's $20 cheaper or when it's $30 cheaper, like in the instance of American Waterworks? Let me give you an example. If I'm eyeballing something that I want to order online and it goes on clearance out of the blue, that might be the sign I needed to pull the trigger. With that said, I've been buying soccer cleats left and right these days. I remember a few months ago it was Casio G-Shock watches, but now I've been collecting soccer cleats, and this is my confession because I have to calm down. My collection of soccer cleats is getting a little too big. Case in point, let's talk about Realty Income Corporation. As the name might imply, they provide a steady income cash flow in the form of dividends every single month. It's one of the most popular dividend stocks for a very good reason. And as of right now, big investors are moving out of REITs like Realty and moving into treasury notes and bonds. Reason being is that they are chasing a safer way to yield 5% with their capital. I mean, right now, Realty Income Corporation's dividend yield is 5.8%. However, the safer way to get that 5 to 5.5% is through those treasury notes and bonds. And because of the high interest rates, Realty Income Corporation's stock price has just been getting punished. However, I truly believe in the power of my nipples, that when the Federal Reserve cuts the interest rates and it comes back down to earth from 5% down to like 2% or even 1%, those exact same investors will be piling back into Realty Income Corporation, because why would they tie up their capital into treasury notes and bonds and whatnot if it only yields 1 or 2%? So while there is fear, I see opportunity. I just can't help it. If I see a high quality business on sale and on discount, I get all excited like a nun in a cucumber field. And to be fully transparent, this past week, as Realty Income Corporation hit that lower $50 range, I was picking it up. And depending on your personal risk tolerance and beliefs, it might sound bizarre considering there are investors and popular YouTubers who will go balls deep into a stock knowing that it's overvalued and trading at a 50 or 60 or even at a 70 PE ratio because they say they have an economic moat. I'm talking about stocks like Salesforce and Intuit. Their rationale is if you are buying for the long term for maybe 10 years or so, then it shouldn't matter what the price is right now. And I get that. But personally, I'd rather buy into the same company when it goes to a 30 PE ratio and is on clearance. But that's just me. And if it drops down to like a 22 or 21, even better. Case in point, Salesforce has a 64 PE ratio and there's people that are buying into it. And the same story is true with Intuit, the company that does taxes. Their PE ratio is at a 61. Is this a good bargain? Is this undervalued? No, I don't think so. On paper, they have great potential. But as a value investor, it makes the skin on my kneecaps really dry when I pay for a trading multiple that is abnormally high. Being greedy when others are fearful and fearful when people are greedy is really sound advice. Because during a bull market, which is like 80% of the time, a majority of investors will become greedy. And it makes sense. People like to buy stocks when it's on an upward trend. And when a majority of the investors are busy being greedy, finding high quality companies on sale is a rare and difficult thing to pull off. On the flip side, historically from 1942 until this year, there has been a bear market about every 5.5 years that lasts about 11.1 months on average. And during those bear markets, what you see on your screen is the orange graphs. Stocks went down on an average of 31%. I mean, that's tough to stomach, right? And that's why Peter Lynch says when it comes to investing, it's not about the brain, it's about the stomach. Can you stomach holding on to a good company when you start seeing it drop 10, 20, 30%? So although one person might be hyper-focused on only the orange graphs, for me, I like to see the world in an optimistic lens, right? I have a really low risk tolerance and I'm very conservative, but even then, I focus on the blue graphs. I see the opportunities, I see the upside, and I see the positivity within investing. So when major investors are selling out because they're scared of the next 6 to 12 months, that's where value investors like me go Christmas shopping. Case in point, when I talked about March of 2020 earlier and stocks dropped on average of negative 33%, that's when I was picking them up. And I really wish I was an investor during the 2000s, during the dot-com bubble crash and the Great Recession, but I was not a stock market investor back then. As mentioned earlier, my logic is if I was willing to buy Apple at $180 a share, why wouldn't I be buying it when it drops to $170 a share? And to be fully transparent, as Apple has been sitting at around the $165 range for this past week, I have been picking it up. And in the spirit of being honest, I'll continue to buy. Apple will always find a way to stay on top, and they're basically included into almost every index fund out there, which means people will be buying into Apple whether or not they want to. When you buy VU, VTI, or any other index fund, it usually has Apple. And if my investing horizon is for retirement, why would I concern myself about what happens this week or next month? Especially when the company reports positive revenue, has incredible free cash flow, and increases their dividend. If you are an anxious person like I am, sometimes it's best not to worry about the little things. And when it comes to worrying about the next 2 weeks for a high quality company, it's just a waste of time. If you zoom out and you look at Apple's performance, they're going to be okay. Throughout their history, they did experience these tiny little dips, but in the grand scheme of things, they always find a way to keep going up.
Well, hey guy, don't you know that past performance is not indicative of future gains?
Yes, I get that, but we're talking about Apple here. This is not some speculative company. For Apple and any other high quality company out there, it's just going to be business as usual and sailing through the sea storm. Do you think just because Apple stock goes on a little dip, it's going to change the influence they have on Gen Z? Or their business fundamentals being a toll booth company? But I do want to call out, the caution here is you can never calculate when the bottom will be. You think you can, but you can never be 100% positive of when a stock will reach its lowest price. As such, you might start buying into a company and it could keep dropping further and further. The current example I can use is Starbucks. Like if you bought into Starbucks back in November of 2023 at $107 a share, thinking that it was a good price because you looked at how back in April they were trading for $114 a share and they went down by $7 thinking, hey, this is a good deal, you might be pissed off, frustrated, and annoyed because since November, they have dropped by an additional 18%. But for me, I just know the long-term horizon for this dividend compounder with cheese will be bright. In the short term, sure, it could keep falling due to inflation and all these different boycotts happening, and it could even reach a new 52-week low, which as of right now, it's $84 a share. And if things get really bad, they could even reach a new 5-year low. I'm not saying that is what will unfold, but it is a possibility. I don't want to paint a Picasso without detailing the alternative outcome of doom and gloom for Starbucks. And since I don't know when Starbucks will bottom out before their inevitable rebound, I choose to dollar cost average. What that means is I'll take my emotions out of it and keep buying a share or two every time it stays near or below my acceptable buy price from my intrinsic valuation calculation, which by the way, I uploaded a video talking about Starbucks valuation. So to me, it's simple. As long as the fundamentals for Starbucks remain the same, if it goes lower temporarily, I'm not even mad. I'm not even phased. I'm not in love with the company, but on paper, they are solid. So it is what it is. I'll keep picking up shares. Now, the alternative to this methodology is someone saying YOLO and throwing $10,000 into Starbucks on a random ass Monday. This strategy is known as a lump sum, where you go all in. You only live once mindset. Believe it or not, some people can do that, but I just can't. I'd rather dollar cost average to have money to deploy in case the stock price goes lower and lower. So even though I don't drink coffee, I have been buying up the stock. And I promise I'm not the kind of guy to hoard all the toilet paper from Costco during an emergency. I have manners and respect for my neighbors. The ones who did hoard all the toilet paper during the pandemic, this is a public service announcement. Your PP is small and smelly and you stink, man. But it is worth mentioning, the real caution and hazard is if the company's stock is on a downward trend for the past 2 to 3 years, then you know something is seriously wrong. And if that's the case, I would resist the urge to buy into that company and instead look at another company. And that's the best part of the stock market and investing in general. There's so many different companies that if you miss an opportunity, it's okay, just move on to the next one. Why fall in love with just one stock? And that's pretty good advice, unless you're married. Then I hope you only choose to love your partner, you dirty little skink. And here's the thing, if we do fall in love with a stock and it has a dangerous future that's not predictable, we can twist the words of Warren Buffett to fit our narrative. But I am telling you, you should never heed this advice of being greedy when others are fearful if the company's stock is selling off for a good reason. If the business fundamentals have changed, if the management quality has been compromised, or if the company has changed directions for the worse, then it isn't the same high quality company that you once believed in. It has essentially made a pivot into being something else. Thus, if you buy the dip, you're buying into another company, which means you ought to go back to the drawing board and draft up a new investing thesis for believing in them. And when you do this, the question we want to answer is, do I want to be an owner of this company? Or is it a dumpster fire that I should probably avoid? Take emotions out of it. Look at the company objectively. Measure the intangibles, evaluate the finances, and judge the leadership. Unless you're the type of person who likes hairy feet, why would you want to invest into a pile of flaming doo-doo? So remember, sometimes a company's stock goes on a dip for a good reason. A bad company on a dip does not mean that that stock is now undervalued. And that's a hard lesson I learned with PayPal. Funny enough, I am a bag holder of PayPal, but I'm not selling because I think they will rebound one day. Which day? I couldn't tell you. That's why I think it's so important and crucial. If you want to be a value investor, you must understand what the company's intrinsic valuation is. If you know from your research and understanding that a company is worth at least $200, but the market prices it for $105, why wouldn't I buy into it? This very example happened to me last year with Target. Left and right, people got emotional and called Target a leftist, liberal company. But on paper and business fundamentals, Target is running a solid operation that has a grip on middle-class Americans, especially with Asians and white women. And I knew that, right? So I bought Target when everyone else was fearful. And to be honest, I got greedy with it. And in the end, Target was able to climb themselves out of the hole they were put into. I separated my feelings and emotions from the company. I knew that it was undervalued and I executed my capital. And I don't share that story to brag, but rather to give an example of how this philosophy plays out in real life. If I wanted to brag, I would just tell you about how I wear a men's size 7 for shoes. And you know what they say about having big feet? You wear big socks. Now, I'm not a stock market genius or even a smart guy. I just use common sense and run my numbers twice to make sure I'm not delusional. If I see a high quality company selling off for irrational reasons, then I will go fishing and hunting like my village depends on me. That's how I've made my biggest gains in the stock market. It gives me a rush just thinking about it. I'll give one more example. Back in March of 2020, it was the pandemic, right? There was a massive sell-off and a lot of fear about the future. And that's exactly when I started picking up shares left and right. I remember buying shares of Discover Finance, a few different REITs, Broadcom, and even Nvidia. Although, regrettably, I sold them before their massive rallies. That's for another video in itself. When to sell a stock is a combination of art and science. And that experience taught me why I should invest when everyone else is fearful. I don't want to beat a dead horse here, but anyways, I want to give you another example outside the context of the pandemic sell-off. When Meta was getting crucified, Meta was formerly known as Facebook, I looked at the company objectively and went all in. And about a year later, Meta rebounded. I did the same with Norfolk Southern. I did the same with Domino's. I did the same with NASDAQ, and the list goes on and on. If you see Cracker Barrel, I actually recommended it as a pass. But I do want to call out, I didn't do this strategy with speculative, shady, or even risky companies. Only with companies that were of the highest quality with a delicious balance sheet. And I'll say it again, like your local Baptist preacher, you cannot apply this quote of being greedy when others are fearful for a terrible company. The shoe will not fit. It's like you telling me how straight you are as a man, but you prefer your women to have armpit hair, bigger biceps than your head, and to be rocking a buzz cut hairstyle. At that point, I don't know, but if you have one too many drinks, I would not be surprised if you make out with a drunk Marine. So I guess the biggest lesson to be learned here is do not make decisions based on emotions. Be objective and try to think long term. And that goes for almost every major decision in life. As a guy navigating through life, it helps to keep calm and to keep your cool, to breathe deep before responding to any situation. I mean, we've all seen it before, right? The guy with anger issues blowing up on the cashier, or road raging as if they're not about to put a family with a toddler into harm's way. Or maybe it was your dad, how quick he was to anger at the dinner table. Do not be like that guy. We have the opportunity to be different as men. And a part of that is learning to control our emotions. So please learn to control your emotions, not only with yourself, but with others in relationships. And if you keep practicing learning how to control and regulate your emotions in your personal life, when it comes to the stock market and investing, your emotional regulation will be on point as well. Which brings me to today's video sponsor, which is your left testicle. No, I'm just kidding. But if you call yourself an investor, then your mentality and mindset should be different than that of a short-term trader. When others are fearful, use your head and trust your number calculations. Leave the emotions out of it. All right, you sweaty nipple. I'll talk to you next time. Stay safe. Dividend compounders with cheese, signing out.